Welcome everyone to this paper, which is a summary of a behavioral approach to financial supervision, regulation, and central banking by Ashraf Khan of the IMF. In part one of this video, we will look at behavioral elements of decision-making. We will see how behavioral elements shape decision-making and look at concepts such as social, legal, and market norms, and also how, as humans, we internalize, identify, and comply with the behavior of others and the impact of psychological biases on our decision-making. The policy and regulatory responses to the global financial crisis have largely been about things that can be measured, such as changes to systems, procedures, and rules like capital and liquidity. These changes were implemented by regulations such as Basel III and the European Solvency II Directive for insurance companies. Also included changes to the way assets and liabilities were accounted for under IFRS 9. Behavioral aspects are still largely focused on corporate governance, such as risk culture, executive compensation, and fit and proper requirements. But elements of the social sciences have a potential to provide significant insights into how individuals make key decisions. And the author argues that this is the way to enhance financial supervision. Traditional economic theory is based on the principle that man acts out of rational self-interest. But this approach ignores the fact that sometimes decision-making is often emotional and at times irrational. The author contends that there are three behavioral influences that affect decision-making. These are norms, the behavior of others, and biases and heuristics. Social norms are less tangible but no less important. These are behaviors which we believe to be intrinsically good and are also good for our communities. Legal norms can be considered formalized social norms. These are things like written laws and case law. While market norms describe the economic supply and demand, and in this context, the exchange of labor for compensation. Social norms are important to behavioral financial supervision. So let's have a look at social norms in a bit more detail. Social norms govern society's behaviors, and individuals are influenced by social expectations, social recognition, patterns of cooperation, and loyalty to group members. They are often formalized into legal norms, and we comply because we believe it is in our self-interest to do so, and because we see others we admire doing the same. An important concept is norm activation, which we will cover a bit later on. Legal norms are obviously important in highly regulated industries such as banking. Legal norms are state-imposed, formalized social or market norms that create clear boundaries and penalties for non-compliance. It's particularly important that the public appreciate the value of following a particular law. Its primary function is to prevent or encourage specific or explicit behavior. From a regulatory perspective, it is important to appreciate the impact and benefit to society. Therefore, regulators will employ the use of regulatory impact assessments to identify the positive and negative effects of proposed regulation. For example, the more complex the regulation, the more bureaucratic and expensive it is to enforce, which leads us to a discussion of a rules versus principles approach to financial supervision. Monitoring and enforcing every law is simply impossible. Therefore, we've witnessed a trend towards a more principles, judgment-based approach to financial supervision. But does existing bank culture enable a principles-based approach? Consider some of the new skills required to implement such an approach. The FCA, for one, stress a hybrid between rules and principles. Now, moving on to market norms. These facilitate transactions and are based on the maximization of individual utility. Market norms are at the heart of modern financial regulation, and free market norms describe the balance between supply and demand. And many say that the role of the regulator is to remove obstructions to finding that balance. But does this model truly capture human behavioral patterns? The next major influence on behavior is the behavior of others. Here we have internalization, identification, and conformity. We observe the behavior of others around us and believe that in acting in the same way, we are doing the right thing and that we are acting intrinsically. As humans, we seek to belong to social groups, and once we identify with that group, we tend to mirror their actions. Whether positive or negative behavior, we act in a manner in which we expect the majority of the group to accept. However, conformity differs in that we try not to do what is different from the group for fear of social sanction. Conformity stems from fear rather than identification. In bank culture, the concepts of insiders and outsiders plays an important role in our perceived importance. Being on the inside confers considerable status in the hierarchical, closed and secretive environment of banking. Now, for a minute, let's discuss agency versus stewardship models of leadership and why this is important in the supervision of financial institutions. In the agency model, manager's interest is not always aligned to that of the shareholder or that of the society. This forms the basis of the theory that performance structures should align the interests of managers and shareholders, like share option schemes. But fundamentally, this model appeals to the self-interest of the manager, which often manifests in a hyper-focus on short-term results. And one can question the influence of this on the stability of the financial system, which is why regulators are keen to move to a stewardship model, under which managers act as fiduciaries, serving the interests of the company without preference to their own self-interest. And pure monetary rewards are an extrinsic motivation that encourages self-interest, implying the need for non-financial elements of recognition and compensation. Consider managerial decision-making. Social or market norms guide decision-making, attitudes and behaviors in the workplace. And the key to principles-based regulation is to encourage managers to act as stewards by appealing to social rather than market norms. This is because social norms link decisions to intrinsic motivations rather than utility maximization, where people act in their own self-interest. Performance-based variable compensation increases the potential for market norms to guide decision-making, in which direct personal financial benefit may run contrary to social norms, incentivizing self-serving behavior. The objective of the behavioral approach is to activate and internalize norms by creating awareness of the consequences of one's actions on society and increasing the need and responsibility to take action. The next major influence on decision-making are biases and heuristics. The World Bank refers to heuristic principles as thinking with mental models. When people think, they generally do not draw on concepts that they invented themselves. Instead, they use concepts, categories, identities, prototypes, stereotypes, casual narratives, and worldviews drawn from their communities. These are all examples of mental models. Some common biases are representative bias, which essentially occurs through stereotyping, and a famous example is Tversky and Kahneman's Linda the Bank Teller case. Confirmation bias highlights how people want to see their own existing beliefs confirmed. Anchoring relates to overdependence on the first piece of information received, and highlights how people would depend too heavily on whatever the first set of data, that is, the anchor that they receive when making subsequent decisions. An example of this is bargaining, where the initial price is used as the anchor by the potential buyer as a reference point, even though it may have no relevance to the actual value of the item. Availability bias relates to decision-making based on examples that come to mind immediately, and often arise where individuals may have experienced something similar in the past. And recency bias is fairly self-explanatory. This arises where more recent events have a stronger impact than older events, whilst salience highlights the impact of real-life experiences on decision-making. Another important concept is imaginability. An example of this is senior bank executives' overconfidence in their ability to imagine all possible outcomes in highly complex situations. And action bias manifests when people see any action, even if counterproductive, as better than no action at all. While insensitivity to sample size occurs when people see patterns in data which do not exist, which is another example of overconfidence in one's abilities. The manner in which people reach decisions is important in financial supervision. So, for instance, the theory of bounded ethicality, similar to the concept of bounded rationality, suggests that people make satisfactory decisions rather than optimal ones because they have limited information or limited time in which to consider the decision. In other words, other factors are at play. Likewise, bounded ethicality relates to how people are inclined to act ethically up to a satisfactory rather than optimal level because of the presence of behavioral biases such as identification or conformity. So ethics, it seems, is dependent on a range of factors, not just the merits of the case. A strong reciprocity describes the tendency of individuals to focus on cooperation, even though there may not be a clear benefit in doing so. This challenges the idea that people are motivated to maximize profit. A Nobel Prize-winning economist, Daniel Kahneman, presented prospect theory as a counter to expected utility as a basis for making decisions. Essentially, prospect theory suggests that decisions about the future are subject to potential gains and losses, and each of these are evaluated differently, subject to their own biases. In Part 2, we'll explore how these concepts might impact financial regulation and supervision and central banking. But first, a quote from the former governor of the Central Bank of the Netherlands. If a banker actively searches the boundaries of the law, he is not trustworthy. For he knows that regulations have a purpose, and he must, if there are good grounds for such regulation, not consciously try to escape those rules. However, in my experience, people do not consciously try to escape rules, but rather rationalize their behavior as being within the boundaries of the rules, which ties back to the previous discussion on norms. So, how would comprehensive financial supervision incorporate behavioural aspects? Two examples are the Central Bank of the Netherlands and the UK Behavioural Insights team. This paper focuses on three main areas: research, supervision, and policy and regulation development. Supervisors and central banks should encourage academic research into behavioral economics and finance. Supervisors should undertake behavioral supervision in addition to regular supervision, communication, and enforcement, while applying behavioral knowledge to policy and regulation development. Developing a research capability is the basis for understanding behavioral concepts. This allows central banks to create an environment conducive to understanding behavior, including the decision-making of the central bank or supervisor itself. This is a departure for many central banks, and they will have to develop social science research capabilities, which, for example, may require the inclusion of psychologists and sociologists in financial supervision teams. In fact, behavioral supervision may require the development of a whole host of new skills. The Central Bank of Netherlands developed a model called the 7 Elements of an Ethical Culture. These are elements of culture that they would like to see in supervised entities. These are enforcement, transparency, visibility, leading by example, openness to discussion, balanced and consistent actions, spirit of the law, responsibility and accountability. And you may ask, how would they do that? Through behavioral surveys, participating in company board meetings as observers, conducting ethnographic and behavioral interviews, and generally creating further awareness of the role of behavior and culture on effective supervision. They believe that a behavioral approach leads to early recognition of behavioral risks and identifying the root causes in organizational culture and company governance structures, which in certain cases leads to greater capital adequacy requirements as a result of perceived behavioral and cultural weaknesses. Turning now to behavioral aspects of regulatory and policy development. Understanding people's behavior is crucial to understanding any potential unintended consequences of regulation. And the ultimate goal is regulation that supports intrinsic motivations linked to social norms in the decision-making of bank managers. And regulators and supervisors too require a high level of self-awareness of their own behavioural biases. The British government's Behavioural Insights team has developed a model called Mindspace, which is a list of behavioural elements created for policymakers in the UK and is drawn from different policy domains such as healthcare, hospitality, and advertising. The M in Mindspace stands for messenger. The messenger determines our reaction to information. I for incentives. People do not always react purely rationally to stimuli. Norms. We conform to behaviours of those around us. We want to meet expectations and follow examples. Defaults. We consciously or subconsciously choose the standard option and do not make an active choice. Salience. New, simple, accessible, and rapid information attracts our attention. That information also creates an anchor point. Priming. Our actions are driven by hints that we consciously or subconsciously observe. Affect. Emotion, mood, and feelings determine our behaviour. Commitment. We try to keep promises and act reciprocally to prevent reputational damage. And finally, ego. We want to feel good about our actions. We act in order to preserve a positive self-image. Consider the complexities involved in decision-making. For instance, you can have all of the other bases covered, but just send the wrong messenger and the impact changes. Now, let's consider the importance of behaviour in the application of the rules. How do regulators effectively influence the behaviour of people and institutions? After all, legislation and regulation generally take a limited number of forms. How people react to them is a crucial element of effective supervision, and behavioural science may help us understand what the most appropriate method of influence and communication might be. So how do we achieve the goal of effective behavioural influence? Do we rely on the normative, persuading and directing? Or do we rely on educational, supporting and inspiring? Or coercive, punishment and reward? In reality, it will be a bit of all three. An interesting approach to culture and governance is Sheffrin's model, attempting to highlight the possible hindrances in behavioural routines, emotional attachments, and social patterns that could lower the effectiveness of supervisory action. To recap, behavioural elements can play a crucial role in the drafting of new rules and regulations, enhancing enforcement, monitoring, and higher levels of compliance, and the application and communication of regulation to the market. In a general supervisory enforcement approach, the supervisor can take preventative measures, protective measures, and punitive measures. Preventative measures are well suited to applying behavioural knowledge. An example where a heightened behavioural awareness might help is the Monetary Policy Committee. The Bank of England should consider the relevance of bias in the MPC and the communication and signalling of MPC decisions to the market. For instance, highlighting the existence of negative group dynamics and the presence of biases, especially the presence of theory-induced blindness. The design of central bank decision-making needs to reflect the optimal alignment between society and the central bank's mandate. Take, for instance, the governance framework of the Bank of England, which is designed to minimize certain behavioral risks. The central bank does not set its own goals, but the tools which the central bank uses to implement policy are independent of external influence. All major decisions are made by committee, with high levels of transparency and accountability. It will certainly take a major cultural change. Another major area where behavior will play a role is central bank communication. It is, after all, about managing expectations. People are, after all, susceptible to the choice of words, medium of information, and the channels of communication. Statements by an authority like the central bank shape beliefs and create an important role in anchoring expectations. The link between systemic events at firm-specific cultural and behavioral levels, exacerbated by weak corporate governance, is the reason why we have a conduct risk industry. Support for a behavioral approach to financial supervision, regulation, and central banking continues to grow. However, the global financial crisis showed us that current policies are not effective enough. In conclusion, using a framework of social, market, and legal norms as a basis for decision-making has great potential. Theories based on people as rational agents or as stewards of a commercial entity do not adequately explain human behavior. More research is required in examining the impact of supervision itself, behavioural elements, and systemic risk, plus the effective application of supervisory interventions. Thank you for listening. We hope you found the paper insightful. Look out for further installments in this series.